Katie, start off with the first question here.
Thank you, Tom. Well, the first question that we have from the question bank is, should I be converting my IRAs to Roth IRAs?
Okay, yes, this is this is one that I put in the bank first because it's probably the most commonly asked question right now. They changed the tax laws and multiple times, and every time it kind of leans more and more towards looking at a Roth IRA. So just very quickly, let me kind of talk about the difference. So you might have a traditional 401k or a traditional IRA, and in those cases, whatever assets that you have in there grows tax deferred. And then once you get, to retirement age, you might start withdrawing on those, and then it's taxable when you take it out. When you get past 72 years old, they make you start taking out a certain amount, and then that amount continues to go up and up over the years. And so if you have a Roth IRA or even a Roth 401k, that grows tax-free. And so you don't have to worry about, paying taxes when you pull it out. And they don't make you take money out past age 72. So it kind of gives you some flexibility with that. Big difference, of course, when you put money into a 401k or an IRA, you get a write-off. And if you put money into a Roth IRA or a Roth 401k, you do not get a write-off. So those are the competing pieces. I would say, honestly, in all of the tax laws that are out there, the Roth concept is one of the most powerful I've ever seen. And it really has the capability of doing, some great things. But the question was about conversion. You are allowed to convert money at any point with any income and any amount from your IRA to your Roth IRA. You can convert from your 401k. Usually you have to be separated from service in order to do that. So this may be after retirement. But I'm going to share my screen here and just give you a little example that I think you might find interesting. So hopefully you can see this well enough. I'll try to describe this. This is a program called Right Capital. And what I've done is I've made a sample plan. So Joe and Jane's sample. And what I'm going to do is kind of show them, in this case you, how to look at the Roth conversion concept and see if it makes any sense for them. So I'll describe what this chart is here. These little lines that are here are tax brackets. The 10% bracket, the 12%, the 22%. And so that's basically, you'll see how important that is just in a moment. Now this green blob here is a projection for how much income that we'll have on their tax return each year for the rest of their lives. So Joe and Jane Sample have $750,000 each in an IRA and about $1 million outside of IRAs. So everybody's got a different dollar amount, and you can still take a look at this, whether you have more or less. But the concepts will still be fairly similar. Now, there are some key criteria to make a Roth conversion work. Number one is you have to pay the taxes with money outside of the IRA. So if I take $10,000 and I move it from an IRA to a Roth IRA, and let's just say my taxes are $2,500, I need to take that $2,500 out of kind of my other monies, my taxable money. I can't take it out of that conversion. It won't work. So that's one criteria that actually cuts a lot of people off from doing the conversion. But Joe and Jane here, they have some money outside their IRA, so they fit that criteria. So then the next thing that we're going to be looking at is trying to figure out what bracket to use, how much to convert, and does it work at all? But we're going to start with what's called the withdrawal sequence, and this is very fascinating. So what it has here is called pro rata. Okay, so what pro rata means is that Joe and Jane hit retirement and they need income. And so they have, say, 10% in one account, and they take 10% of income out of that account. They have 15% in another account. They take 15% out of that account. This is not a concept I see very often, but what they're doing in this program is using this pro rata as kind of a base for you to take a look. And then as we make adjustments, you can see how it changes. And what we really want to focus on is how much more or less we have based on different things that happen as I change these parameters down below. So very quickly, we'll look at the standard distribution methodology, which would be to take, in Joe and Jane's case, to take their incomes first from their taxable accounts, and then tax-deferred accounts and tax-free accounts, which would mainly be Roths, in that sequence. Well, you can see here that adds $650,000 more to their net worth, which is great. That's really a big deal, actually, just by having that sequence. Now, just to kind of emphasize how important this is, I'm going to go down here and do the wrong sequence. So you'll see this goes $750,000 less. And so what this sequence is they're going to go to their IRAs first and use those, and then eventually get to their taxable accounts, and if they have any, they would use their tax-free. I see this sequence all the time, and what people tell me is, hey, I saved in my IRAs or 401ks or what have you. Those are my retirement accounts. I'm now retired. I'm going to take money out of those retirement accounts. Well, unfortunately, in this particular case, if you do that, they'll actually end up with $1.4 million less in net worth. So let's go back to the standard, and we'll leave that as our base case now. So remember the $650,000. So now we're going to go down here and just take a quick look at converting IRA. So this little slider allows me to try different levels. So what I did here first was I said, all right, if we have any room inside the 10% tax bracket in any 1 year, we want to convert and fill in that bracket. Well, it didn't do anything, mainly because they already have the 10% bracket, that's this line here at the bottom, filled. All right, so then we go to the next one. 12%. Now it says 12/15 because the current tax brackets sunset and disappear in 2025, and unless Congress continues them, they'll actually go back to 15% where they were before. So we're assuming that they don't, go back. I mean, assuming that they don't get keep at 12%, it actually goes back to 15. Now we can see that there's an increase, 918 instead of 650,000. So converting at the 12%, and you can kind of see here where it filled in. See that? The little blue part, it filled in the 12%, and that's why those lines are important. All right, a couple more here. 22%. Wow, big difference. $1.4 million increase, right? If we go to 24%, actually goes backwards. See that? So what that just told me was that the optimum bracket for Joe and Jane to fill is 22%. And what's really, really wild here, if you look closely, at age 85, if we make the conversions, they'll be done converting at about age 82, and they'll have zero income, taxable income at age 85, which is a completely different standard of living, versus if they don't make the conversions, they end up with $278,000 worth of taxable income, which is really, kind of a big piece here too. So the other big criteria, just to cover, is that people see it, they like it, they want more money, but when it comes time to actually paying the taxes, it can be really painful. Because if you look here at the first year, they would have had $47,562 worth of taxable income, but they're filling in the 22% bracket, which is $172,000. That's a lot of money to pull out of your pocket to pay taxes. So you have to be committed to make this work, but it can be life-changing. And it also makes a big difference to beneficiaries. If you look here, in their current case, they don't have any tax-free assets. So everything that would be inherited would be in these tax deferred or taxable accounts. And the tax deferred section here has to be taken out over a 10-year period. So the kids, or if that's who it is, would be paying taxes, versus over here, we've got 100% tax-free, income tax-free estate, which is really, an unbelievable situation to leave your kids. They still have to take it out over 10 years, but anyway, that's how that works. So hopefully that helps explain a little bit, how the